David R. Guttery is an investment advisory representative of Emeritus Investment Corporation and president of Keystone Financial Group in Trussville, Alabama. Please stay tuned through the end of the video for additional important disclosure information.
Today I am joined by David Guttery, president of Keystone Financial Group in Trussville, for a discussion about 2019 and what it may hold for investors. Good morning, David.
Good morning. Happy New Year.
Happy New Year to you. David, last year was certainly a departure from the relative calm that we saw in 2017. What caused a return of volatility, and do you think it will persist in 2019?
Well, volatility really never goes away. Indeed, the 15 months between November of 2016 and February of last year were unique in that volatility was largely absent, but over time, such is a consistent element of the market. As we've discussed in prior videos, markets are simply discounting mechanisms. They constantly reprice risk as the landscape changes. Now, don't confuse discounting with forecasting, however. The markets don't have a stellar track record when it comes to predicting the future. They aren't forecasting mechanisms, but rather discounting mechanisms. The cause of volatility was largely related to imposed tariffs by the U.S. and retaliatory tariffs by other countries. The markets priced into themselves the risk of such evolving into a global trade war and the impact that such might have upon previous assumptions of economic growth. Other concerns were related to Brexit and the unwillingness of Republicans and Democrats to compromise on spending measures that resulted in a government shutdown. Certainly the markets focused upon the Federal Reserve as well and discounted the impact of current and future monetary policy into its assumptions about economic growth. Yes, I believe that volatility will persist throughout 2019, but hopefully with fewer cathartic swings. Markets move on perception and fear sometimes, but over the long term, they are generally driven by what can be quantified. The quantifiable economic data looks about as strong as I've seen it over the duration of my 28-year career. The good news is that if we were to suddenly find ourselves with a trade agreement with China, or a resolution to the government shutdown, or if what's been known of Brexit since 2016 remains intact, or if Chairman Powell reassures the market that the Fed remains measured and data-driven, then this correction, largely induced by fear, could resolve sharply as well.
What about the strength of corporate profits in 2019? Wasn't the market somewhat skeptical about such strength continuing throughout the new year?
Yes, that also contributed to the slew of economic concerns that worried the markets in the last quarter of 2018. Haver Analytics and other sources offer historical evidence of corporate earnings, and the current trends just don't support the recent skepticism. From the fourth quarter of 2005 through the third quarter of 2008, we noticed a gradually deteriorating pattern in corporate profits. We see no such pattern evolving today. Indeed, we see 7.1 million unfilled skilled labor jobs and companies spending a lot of money to train people to fill those jobs because consumerism remains strong and companies must expand their capacity to meet increasing demand that isn't slowing down. In the face of such spreadsheet evidence, on the 3rd of January anyway, I can't see any reason to believe that recent patterns of corporate profitability should change.
David, we heard the R word again last year, recession. What are your thoughts on this? Are the markets overly discounting the possibility of a recession this year?
In my opinion, the chances of seeing a recession in 2019 are about as great as Birmingham seeing snow in July. The elements just aren't there. That doesn't mean that geopolitical risks can't suddenly alter that equation, but based upon what I can quantify on a spreadsheet today, you just don't get a recession when the economy meets the definition of being at full employment. And the 4-week moving jobless claims average is just off an October 1968 low. The ISM manufacturing and non-manufacturing indices are right around 60. Non-defense capital goods spending is this strong. Factory orders and new orders are this strong. The housing market is this strong. And leading economic indicators are this strong. The October and November consumer confidence readings were the highest seen since the end of the last recession. We just experienced the best Black Friday and Cyber Monday in the history of tracking the metric, and the Red Book retail sales data in December was historically strong. Confident consumers spend money, and we can quantify the degree by which they've done so. Consumerism is 70% of GDP, and we just saw the first 12-month period of time since 2005 where GDP grew by more than 3%. None of this data is consistent with an economy tipping over into recession. So yes, that fear has been overly priced into the discount of the stock market.
So, in summary, what advice are you giving your clients with regards to their investment plans for the coming year?
First, review and reflect upon your objective and the time between now and the realization of that objective. If you remain with a long period of time between now and then, remain true to the plans that you've put in place. Have the intestinal fortitude to make such periods of volatility work for you. Invest through the lows into your 401k and other plans. By doing so, you are purchasing greater numbers of shares with static monthly investments, and over time, such dollar cost averaging will reward persistent and patient investors. For those of my clients without long-term holding periods, who are near or into retirement and focused upon the production of income, their allocations didn't call for a large exposure to risk assets in the first place, and they're generally weathering this period of time in good shape. Everything is driven by your objective and tolerance for risk. Look, markets worry. Sometimes it's a full-on panic, but my job is to remain dispassionate and advise clients accordingly. Right now, we have an abundance of what-if induced panic and an abundance of strong quantifiable data. Remain focused on your objective. Rise above the what-if and be driven by the quantifiable.
Thank you, David. For additional information, David may be reached through the means listed upon the following screen. For the Trustville Tribune, I'm Tana Friday.
David R. Guttery independently offers securities and investment advisory services through Emeritus Investment Corporation, member FINRA and SIPC. AIC and Keystone Financial Group are not affiliated. Additional products and services may be available through David R. Guttery or Keystone Financial Group that are not offered through AIC. Some of the products and concepts discussed have their own cost and are subject to risk, including the possible loss of principal. These costs and risk will be thoroughly discussed with you prior to any recommendation or solicitation. Past performance is no guarantee of future results. Information provided is gathered from sources believed to be reliable. However, we cannot guarantee their accuracy.